Well, hello and welcome to the CNBC TV 18 special. I'm Shereen Bhan and we're in conversation with the Chief Economic Advisor, Mr. Arvind Subramanian. Appreciate you joining us here on CNBC TV 18. Apologies for dragging you out in the heat, but that's the sort of environment that the economy is facing as well at this point in time. Let me start with the good news. The fiscal deficit in control. You've been able to better the target of 4.1% to 4%. The current account deficit under control. Inflation under control. FDI at record highs at the month of May. That's the good news. The bad news is that the IIP numbers continue to look weak. The bad news is that crude is actually up 30% since the time that you presented the budget in February. The rupee, I don't know which way you want to look at it. Bad news for imports, good news perhaps as far as exports are concerned. The government may dismiss criticism that not enough has actually changed on the ground, but the recovery and the slowdown as far as, or the pace of change, you can't argue with the fact that it perhaps has been slower than what you anticipated.
Yeah, so I think, you know, the macroeconomy is turned around, as you said, and the question is whether, you know, economic growth has turned around in line with expectations and in line indeed with the actions that have been undertaken. Yeah? And we can talk about that. But I think that it's fair to say that the real economy is recovering, still not surging. But on each of the points that you said, and let's take each of those in turn, right? First, you said the IIP numbers.
Yes.
And first, I want to caution you about the IIP numbers because, yes, IIP growth is about between 2, 3, 4%, that range, but it's a volume number. So the fact that at the same time input prices have been coming down means that the way we measure value added, it's doing slightly better, right? One. Second, oil prices, yes, they've come up, but we never expected it to be in the 45 in the first place. I mean, we expect oil to be in the 50 to 75, 80 range, and as long as it's in that range, I think oil prices are manageable. Now, the one piece that you didn't mention, and I think that's the piece of more recent good news, you know, we just presented this at the press conference. We just analyzed the April data on indirect tax revenues. And, you know, if you do it properly, strip away all the new measures, it seems like the April numbers are pointing to an uptick in recovery in a reasonably healthy manner. So I would say that, you know, there are signs that the economy is starting to pick up again. And, yeah, do we want it to be faster? Sure, we need to be. But then, you know, as long as the reforms continue and we, you know, address some of the other short-term concerns, I think there's no reason why we shouldn't meet our growth target for this year that was there in the budget.
Talking about the growth targets, and do you believe that the downside risks to being able to achieve that growth target have gone up? We've already seen several people, whether it's Ambit or Macquarie and a bunch of others, now revise downwards their GDP forecast for FY16 to about 7% to 7.5%. Do you believe that an 8% plus growth rate that the economic survey and the budget held out for FY16 now in danger?
Well, I mean, look, it's too early in the year to start revising forecasts down. I think part of the reason they may have done that is because, you know, maybe Q4 of last year is going to be lower than we expected. So relative to that, there's some corresponding revision.
So lower than 7.4%, which is what you will need to do to be able to get to 7.4% for FY15.
FY15, no, FY15 we had assumed it would be around 7.4, 7.5, right? That's why we thought there'd be an additional half a percentage point to 1 percentage point next year. So those numbers will come in very soon, and let's look at those numbers. But the key point is that is growth next year going to be, you know, reasonably greater than last year, whatever the last year number was? And I think we're still on track for that. I don't think it's too early to say that we have to revise down that increase in growth we're forecasting.
But are you getting concerned that people are now actually revising downwards their GDP forecast? I talked to you about Ambit. For FY16, it's now 7% versus 7.5%. 7.9% was their earlier target, so this has been revised downwards. Macquarie, similar story playing out for both FY16 and 17 as well. Do you believe that the numbers that you've held out are in danger of not being met?
Well, as I said, I think these numbers, I mean, I don't set too much store by these downward revisions because, you know, unless they're based on some information that we don't have, I don't know what that information is. But I think that as long as we continue with, you know, what we're doing, and as I said just now, you know, we need to work on public investment, private investment and consumption. If we can work on that, there's no reason why we shouldn't, meet the targets that we've set for ourselves.
Okay, let me ask you about consumption, because you talked about that in your address as well, and you said that policy action will be needed to boost consumption. At this point in time, we're perhaps staring at a subpar monsoon. You know the distress that we're seeing in the agriculture sector in rural India at this point in time. Perhaps not enough has been done by the government to spur consumption, because the emphasis and the focus has been on reviving investment. But that's the structural long-term story. In the short term, what do you think needs to be done from a policy point of view to revive consumption?
So I think that, as you said, we need to address this distress in rural incomes. I think, consumption has benefited from reduced price of oil. It's put more money in pockets. It's also benefited from the interest rate cuts we've had. And so the question is, going forward, public investment has to be ramped up. And on consumption, the question is looking at all the factors, the inflation forecast. Maybe we need also some help from other policy instruments, including easing of monetary policy. But depending upon the inflation forecast and everything, that's a call that the RBI will have to make. But I think that the policy levers that the centre controls, the big ones are public investment. We've, I think, created the conditions in terms of the quality and quantity of fiscal consolidation to permit easing on other fronts, and we have to address the distressed assets problem so that can get private investment back again. So we have to work on all three fronts.
But speaking specifically as far as the monetary policy is concerned, we've got the credit policy on the 2nd of June, and there's no secret in the fact that the Finance Ministry believes that there should be an aggressive cut from the Reserve Bank of India. Given where inflation currently stands, do you believe that 25 basis points ought to be a given on the 2nd of June? Do you believe that there is room to be more aggressive? How much would you see by way of rate cuts through this year?
See, again,
I'm not asking you to second guess, but I'm saying, what is the North Bloc view?
See, there are probably as many North Bloc views as there are secretaries in North Bloc and ministers.
So let me ask the Chief Economic Advisor, what your view is.
See, my view is that, I think that the inflation is relatively well contained. I feel that the fiscal deficit, actually the consolidation, is going to be greater than we had even forecast in the budget, both for last year and going ahead. And we have to look at the international environment. The international environment is that almost every country is pursuing aggressive monetary, which is also de facto devaluation of all these countries. So I think you have to factor all these things into account when interest rate decisions are taken, and that's a call that the RBI will make. But I think there is scope for easing.
Significant easing, more than 25 basis points?
That's something that sure, RBI will decide. But I think I think the inflation front is one of the things that is one of the bright spots of the economy, and we also don't want our exchange rate to get uncompetitive in the face of, I think, what is really quite aggressive action by other countries.
Speaking of the rupee, let me get your view on that before I talk to you about some of the other worrying trends that we're seeing. The rupee has depreciated about 8% year to date. Of course, other emerging market currencies have also depreciated, and much more significantly in comparison to the rupee. As I said, it's good news for exports, it's bad news as far as the import bill is concerned. What is the outlook as far as the rupee is concerned, and what makes you comfortable? What level would make you comfortable?
By the way, sorry, this is something that just I want to clarify this, that when the exchange rate depreciates, that it's also good for the reducing the import bill, because imports become more expensive. So an exchange rate depreciation is good both for exports and reducing imports.
Specifically on the oil front.
See, the oil front, I think it's because it's inelastic, maybe the impact will be less. But so, I think the way to think about exchange rate policy is what is our conception of our development strategy and Make in India? Do we believe in Make in India? Do you want to realize Make in India? And if that's the case, the lesson of the East Asian experience is that we have to be competitive. Nirmala Sitharaman said this some time ago. I think exchange rate policy is the most important policy for Make in India and exports. So I think, and especially at a time when our partner countries are depreciating, I think we cannot afford to allow our exchange rate to become uncompetitive. So I think we have
to... Are we competitive today, you believe?
Well, I don't know what I do know, until very recently our exchange rate in competitiveness terms had depreciated by about 10% over the last 12 to 14 months and become less competitive. So I think that's been hurting our exports. So I think any further thing will actually, so the recent decline in terms of the dollar, I don't think is such a bad thing. But as you said, others have also, so in an overall sense we may not have been much better off than before. So I think the key point is that it's something that we have to be watchful about. We have to ensure that it doesn't become uncompetitive, and especially at a time when the world is behaving very aggressively vis-a-vis their own currencies.
Another worrying trend which really hasn't seen any significant change, credit growth has dropped to an 18-year low, deposits at a 19-year low. This certainly has got to have the government worried, and followed or linked to that is then the question of when do you expect a turnaround, when do you expect a real recovery?
See, one thing, that credit growth number is not quite correct, because you have to adjust for the fact that inflation has also been coming down. So I just showed a chart which your colleague
a slight improvement.
Yeah, slight improvement. So things are not deteriorating. They've been arrested, they're getting slightly better. And you also have to remember, you also have to look at where else companies are getting financing from. Foreign corporate bond market, and if you put it all together, you do see an uptick. So it's not a continuous deterioration, but that number reflects the fact that demand is still relatively weak. So I think we need to address that private investment, the overhang of distressed assets.
What can the government do to be able to address the issue as far as broken private sector balance sheets are concerned?
No, I think we need a mechanism by which we look at all these stalled projects. We look at...
Has there been any improvement? Because I remember in the economic survey you said that the stalled projects were about 7% of GDP.
The stalling rate has come down. Stalling rate has come down, but we don't see quite the pickup in new projects as much. So in a sense you could say that the bad stuff is happening less, but the good stuff hasn't picked up as yet, or not as strongly as we'd like to. And so I think there is something that government, and this is something the government is giving the highest attention to, have a mechanism. You get the promoters, the creditors, everyone together, certainly the big ones, you bang heads, you allocate the costs, clean up balance sheets so that people can go forward. And that's the process, I think.
But in the past 1 year, then we haven't made any significant progress as far as this particular issue is concerned.
Yeah,
would you agree with that?
Well, stalling rates have come down, so I think we've made some progress, but perhaps not enough. And this is something that is going to have to be addressed with the highest. And the awareness is there at the highest level that this is a problem and that needs to be addressed. In fact, we've seen recently 2 projects in the road sector which have been cleared exactly pursuant to this process.